Hi everyone, I'm Devon Coombs, CPA, and today I'm going to go over deferred revenue, specifically related to cash sales of services not yet performed. There's going to be an oversimplification in this class. This is just for introductory understanding of deferred revenue, but I'll cover some of the complexities that you may confront in your business down the road and in later videos, and I'll just make sure I address them briefly here. So let's dive straight into it. So, cash sales of services not performed. On December 1st, 2019, Coombs Inc. received $6,000 to be on retainer for a customer for the following year, with the retainer expiring November 31st, 2019. So this is pretty common in business. As a consultant, I might have a client who wants to use my services, doesn't know how much they'll need it, but knows that they'll need to reach out to me for a period of time, normally within a year, and need to reach out to me periodically for my advice. So I may get paid up front for that advice for over a year. And provide a discount for that. And so first we'll have to do the journal entry for the receipt of cash, right? So we debit cash. Coombs Inc. will debit cash of $6,000 and credit deferred revenue, which is also now known under ASC 606 as contract liability. So deferred revenue and contract liability are synonymous. So the journal entry is debit cash, which is an asset, current asset, for $6,000, and then credit deferred revenue being a liability. So that liability that can have a current portion and a long-term portion, but since this is all within 1 year, to be a current liability, and that's the journal entry. So debit an asset, credit the liability. And the reason this is a liability is because I owe services to my customer. So even though I've been paid, I owe those services to my customer, who is my creditor in this situation. So let's continue. That's not the only journal entry you have to recognize. We also have to recognize a journal entry at the end of the period, that's this calendar year, on December 31st, 2019, for the revenue recognized. So for the revenue I've earned, right? I can't recognize revenue until I've satisfied my performance obligations or earned the revenue. And so for this example, I earn the revenue monthly because they have access to emails and 2 hours of calls a month. On a monthly basis. If they don't use those calls, I still collect the revenue because I have a stand-ready obligation to the customer. This would be different if I was charging on a times and materials basis. It'd be different if I'm selling goods. Revenue recognition can get kind of complex on when revenue is recognized. It's recognized when a performance obligation is satisfied, but I'm going to go into that in more detail in revenue recognition videos. But as an introductory lesson, just understand that I'm performing the services equally over the 1 year, and so all I have to do is divide this 6,000 by 12 to determine how much revenue I can recognize, what I've earned as of December 31st, 2019, which is the $500. That's 6,000 divided by 12 is our $500. So next step, we have our T accounts. We just need to make sure our debits equal our credits. Do they? Yes, they do. They're $6,500 each. So our assets are cash of $6,000, which increases because it has a debit normal balance. Assets increase with a debit balance. And our liabilities have decreased after adjusting journal entry. Our deferred revenue decreases by $500. Our liabilities have increased, which is a credit normal balance of $6,000, and our revenue has increased by $500 when we recognize that revenue. And so this journal entry agrees. This is our first journal entry, and the liabilities and revenue is our second journal entry. Our outstanding balance at the end of this of deferred revenue is going to be the $6,000 minus the $500 because $6,000 liabilities have a credit balance, normal balance. So this $6,000 is the value, which is then decreased by this liability. And so we know our debits equal our credits. So our first rule of accounting, that debits always equal credits, is satisfied. So let's check our financial statements and see if the accounting equation is also satisfied in the balance sheet. But before we can get to the accounting equation, we need to first do the income statement. So let's dive straight into it. The income statement, our revenues now have increased to $5,500. So in our prior report, we had 5,000 here. And so you have to see the previous videos, they all build upon each other for the financial statements. But this 5,000 now is recognized in this revenues. Our general administrative expense hasn't changed, and now we have a positive net income of $4,950. So we know now our net income amount, which then is going to flow into retained earnings. So we have this net income. Now we can prepare our statement of shareholders' equity because we know our net income, which will increase our equity, right? Our income statement flows into our equity as part of retained earnings or accumulated deficit. And so that's what we see here. Our retained earnings now has increased by the $500. So that 500 increased here, and that 500 increased here for net income. So that net income transfers to the retained earnings. And so nothing else would change here. We didn't get any other financing for our business. But what this is saying, right, just to remind everyone, is we have financed our business through investment from an owner. Investment from an owner is the common stock and APIC, and then through our operations. That's how our company has financed itself. That's what our statement of equity is stating. From an owner's perspective, not from a liability perspective. The balance sheet will show the liability perspective. And so these are the total balances for the accounting equation at the end. And so how did we determine these balances and that it ties? So remember, the balance sheet is just a presentation of the accounting equation, which is assets equal liabilities plus equity. So our assets are now $16,200 cash. That cash increased from our collection. So previously, this didn't include the $6,000 in our previous video. We had our prepaid rent and our net equipment of $1,750. So that equals $20,450. So these are everything the company has a right to use. That's funded through our liabilities, right? We owe services, we owe deferred revenue. We have deferred revenue, we owe services to our customer of $5,500. That's the 11 months left of service, which we calculated through that difference, the $6,000 minus the $500 we amortized. And our equity, which we covered, this retained earnings amount comes from our statement of shareholders' equity, and which is a flow through of our income statement. And then we talked about the APIC and common stock. So our assets, our $20,450, are partially now owed to creditors, right? We owe services to a creditor who is our customer, and are financed through our owners, right? And our operations. So always remember this. This is how I remember it. What you have is equal to what you owe and what you own, right? So what we owe some services to a customer, and the rest is what we own, either through our own cash investment, our investor cash investment, or through our operations through retained earnings. And then let's see how this affects the statement of cash flows. So deferred revenue, since it's a current deferred revenue is going to be a change in cash in operating activities. And so we're going to see it right here. This deferred revenue line has now been added, and our net income has been adjusted. So the net income is always going to tie to our income statement, that $495.50. That's how we'll always check that. $495.50. Our deferred revenue is $5,500 at the end of the period. And what we're saying here is this $5,500 was not included in income, but we've received cash for it. So from operations, from this short-term liability, we have received cash, which will increase our cash flow from operating activities, right? It's a good thing to receive cash early. And so this is a positive effect. Even though we can't recognize revenue yet, according to GAAP, we can recognize it as cash flows from operating activities. Our short-term assets, short-term liabilities are going to affect these operating activities. And so even though our short-term liabilities increased, that means that we were able to receive cash in advance in this case. So generally when our short-term liabilities increase, you're going to see an increase in our cash flow because we're able to see increases in cash. If they decrease, we're going to see a decrease in cash flow because we had to pay for those liabilities. If we see an increase in our asset, it decreases our cash flows, and that reciprocal arrangement, which you can see on my statement of cash flow videos. So this is where we're going to see changes. Net income changed and deferred revenue changed. Nothing else changed here. There's no investing activities, there's no long-term assets, and there's no financing activities, no long-term equity. So long-term liabilities and equity. So that's it, right? Please watch these videos in order so you can really see how these financial statements are being built, and I promise you'll get a great understanding of accounting. Thank you again for watching. I will be making another video on other revenue transactions, and as we continue to build this business, if you have any questions or want me to do any videos on any specific journal entries, feel free to write in the comments below. Thank you so much for watching, and have a great day.